The critical distinctions between qualified and non-qualified retirement plans are a major focus of the national portion of the life insurance exam. This topic is a frequent source of points because it tests your understanding of federal regulations and tax law. When we talk about a qualified plan, we are referring to a retirement arrangement that meets the specific requirements of the Internal Revenue Code and the Employee Retirement Income Security Act of 1974, which you will often see abbreviated as ERISA. The most important thing to remember for your test is that qualified plans are designed for the benefit of all employees. They must be non-discriminatory, meaning the employer cannot simply offer the plan to the high earners and exclude the janitorial staff. If the exam describes a plan that must follow strict participation and vesting rules, you are definitely looking at a qualified plan. One major advantage of these plans is the tax treatment. For the employer, any contribution made to a qualified plan is a currently deductible business expense. For the employee, those contributions are not treated as taxable income in the year they are made, and any earnings on the investments grow tax-deferred until the money is withdrawn. On the other side of the spectrum, we have non-qualified plans. These plans do not meet the formal requirements of ERISA and therefore do not receive the same favorable tax status as qualified plans. The most important characteristic of a non-qualified plan for exam purposes is that it is discriminatory. This sounds like a negative term, but in the insurance world, it simply means the employer can pick and choose which employees are allowed to participate. You might see this referred to as an executive bonus plan or a deferred compensation plan. Because these plans are not governed by the same strict ERISA rules, the employer does not get an immediate tax deduction for the contributions they make. Instead, the employer must wait to take the deduction until the employee actually receives the benefits and reports them as income. A common exam trap is a question asking which plan has no limits on contributions. While qualified plans have annual limits set by the IRS, non-qualified plans generally do not have these same statutory caps, making them ideal for high-income earners who want to save more than a standard retirement plan allows. When you are sitting for the exam, you need to watch out for trick wording regarding the approval of these plans. A qualified plan requires formal IRS approval of the plan document to ensure it meets all the legal standards for non-discrimination and vesting. A non-qualified plan requires no such approval and is essentially a private contract between the employer and employee. Another point of confusion often arises around the concept of vesting. In a qualified plan, there are legal minimums for how quickly an employee must become the owner of the employer's contributions. In a non-qualified plan, the employer can set much more restrictive terms, sometimes meaning the employee loses everything if they leave the company before a certain date. Furthermore, in a non-qualified plan, the money is often still considered an asset of the company and could be seized by the company's creditors, which is not the case with a qualified plan. To help you keep these straight under the pressure of the exam, use the phrase, qualified is for the crowd and non-qualified is for the chosen. This phrase should immediately trigger the realization that qualified plans must be fair to the entire crowd of employees, while non-qualified plans are for a chosen few. You should also remember that the word qualified effectively means qualified for special tax treatment from the IRS. If a plan does not jump through the hoops of ERISA, it is not qualified for those immediate tax breaks. Expect to see questions that ask you to identify which characteristic does not belong to a qualified plan, and the answer will often be something about being able to favor certain key employees. By keeping the non-discrimination rule and the timing of the tax deduction at the front of your mind, you will be well prepared for any question on this topic.